Today, we're going to start off by looking at employment expenses. Now, when it comes to employment expenses, if you're working for a company, chances are you're not going to have that many expenses that you can deduct. So the way that the income tax rule works is that for most of the employment expenses that employees are allowed to deduct, most of them will require the employer to complete this form T2200. So this form T2200 basically is the employer's way to certify that this employee is able to deduct certain expenses. And as part of their conditions of employment, the employer requires this employee to incur certain expenses. So for most employees, they're not going to be able to make many deductions from their employment income. Certain employees that require to work from home, or maybe certain employees that are commissioned salespeople, then they need this Form T2200 signed by their employer before they're allowed to deduct certain expenses. Now, there are some expenses. So there are some expenses that do not require the T2200 to be completed. And those are examples would be union dues and professional dues. So if you end up working for a company and they have a union and you're required to join the union, you're going to have to pay union dues. That is allowed to be deducted when you're calculating your employment income. So that is an allowable employment expense that does not require the employer to complete this T2200 form. Also, professional dues. If you end up graduating and you end up getting your CFP or your CPA, and that's part of your work, you're an accountant, you're a financial planner, and you pay for your own professional dues, you can deduct that when you're calculating your employment income because you need that designation in order to perform your duties. So those are a couple of exceptions that do not require this Form T2200 to be filled out by the employer. Now, moving on to the handout, there's 5 parts of the Income Tax Act that talk about deductibility of employment expenses. And specifically, there are 5 paragraphs. So I've kind of listed them here. ITA 81F, so 8 stands for section, the first bracket 1 stands for subsection, and the F stands for paragraph. So that's one of the paragraphs that talks about employment expenses. There's 81H, 81H.1, 81I, and 81J. Now, the way that it works is that, let's just start off with 81F. 81F is only allowed for commission salespeople. So if you're, let's say, a car salesperson and you earn commission, then you can deduct certain expenses under 81F, once again, provided your employer completes this Form T2200. If, for example, you're a salesperson, maybe you sell commercial real estate, once again, if you're a commissioned salesperson as an employee, then you would be able to qualify to deduct certain expenses under 81F, once again, provided your employer completes this Form T2200. Now, when it comes to 81F, if you're a commissioned salesperson, your deduction under 81F is limited to your commission income. So there's sort of a cap there. If you earn very little commission income, then your expenses that you can deduct under 81F will be limited to whatever that commission income is. Now, if we move over to this side, we have 81H and H.1. Now, under H are travel expenses. So if you have to travel for work, you pay for your own hotel, airfare, taxis, trains. If you're away for at least 12 hours, then 50% of your meals would qualify as well. So that's what we mean by travel expenses under 81H. Now, this does not include meals with clients. So you can only deduct your own meals if you're away from your city or town for at least 12 hours, 50% of those. Under H.1, we have motor vehicle expenses. So if you're required to use your own personal car for work, then you can deduct gas, insurance, operating costs. And usually that's prorated based on the number of employment kilometers you drive divided by the total kilometers you drove for the year using your personal car. So once again, this is different from what we saw last week. Last week, we were looking at the automobile standby charge and the operating cost benefit. That was an example where the employee was using the company car and they got to take the company car home with them, use it on weekends and evenings. So there was a benefit that they had to include in their income. 81H.1 says you are an employee, you're using your own car to do employment duties. So you can make these deductions under H.1. Now, the way that this is a little bit complicated is that everything in H and H.1 is included in 81F. So if you're a commission salesperson, you can deduct travel expenses, motor vehicle travels, plus a bunch of other expenses under 81F. But if you make the deduction under 81F, it's limited to your commission income. Or you can choose to deduct H and H.1. But H and H.1 are limited to just these expenses listed here. So what's included under 81F that makes it sort of include so many more expenses? Under 81F would include things such as advertising and promotion, accounting and legal fees, cell phones, meals with clients, 50% of the meals with clients. It also includes all the H and H.1. So remember we talked about travel expenses. H.1, all those are included under F as well. It also includes work from home expenses under 81F. So if you're a commission salesperson, you need to sort of make a decision. If you're able to claim expenses, you need to decide, are you going to claim them under 81F or H and H.1? And we're going to go through some examples to sort of identify which is better under different scenarios. Now there's two other paragraphs, 81I, that includes those union and professional dues. It also includes home office expenses. And then there's J, which includes interest on loans and CCA. CCA is something we're going to talk about in chapter 5. But this is basically, let's say you have to borrow money to buy a car to use for work. Then you can deduct the interest on the car loan, and you can deduct some depreciation, also known as CCA, on the car as well. So the only sort of complication is if you are a commission salesperson, do you claim under F or do you claim under H or H.1? Because you can't claim under both. It has to be either F or H and H.1. But if you claim under F, the benefit is it includes all these other expenses listed from the textbook, but it's limited to your commission income. So let's sort of take a look at a simple example. So let's say we have this commission salesperson, and let's say their employer completes that form T2200, and so they're allowed to deduct expenses. They have 2,000 in travel expenses, so that would be things such as airplanes, hotels, taxis, 5,000 in motor vehicle expenses. They've already prorated that based on their kilometers used for employment over the total kilometers driven. And they also have 3,000 in advertising expenses. And so now we got to figure out, okay, which of those expenses can they claim under F and which can they claim under H and H.1? So when it comes to the 2,000 of travel expenses, that can be claimed under either F or H and H.1. When it comes to the motor vehicle travel, again, that can be claimed under H and H, well, actually be claimed under H.1, or it can be claimed under F. Now, when it comes to the advertising, that's the one that is only available under F, not available under H or H.1. So we have the 3,000 here. So if you were a commission salesperson, then the total expenses that you could deduct, once again, would be 10,000. But once again, if you claim under 81F, that is limited to your commission income. If you were to claim under H and H.1, the total would be 7,000. So then there's no like right or wrong answer per se. It really depends on what your commission income is. So let's look at example 1 down here. Let's say this commission salesperson earns a $70,000 salary plus 4,000 in commission. And so now they got to make a choice whether they're going to claim under F or H and H.1. If they claim under F, yes, they have 10,000 in expenses, but it's limited to their commissions. So their deduction would only be 4,000. If they claim under H and H.1, they could claim 7,000 because there's no limit based on their commission income. So in this example, the better choice would be to claim under H and H.1 because they get a larger deduction. And they can change this year to year. Every year they can sort of do this analysis, figure out how much commission they made, figure out what their expenses are under F versus H and H.1, and then make this decision. So that seems fairly straightforward. Any questions about the first example? If we look at the second example, this employee earns 70,000. This time they have 8,000 in commissions. So under F, they can make an $8,000 deduction. Even though they have 10,000 in expenses, they can only deduct under F based on their commission income. Under H and H.1, then it would be 7,000. So in this example, the optimal deduction would be under F because they get a larger deduction because it's based on their commission income and how much is eligible under F. And so that would allow 8,000 of deductions versus 7,000 under H and H.1. So that seems fairly sort of intuitive how to do this analysis. What I'm going to do then is now move to an exercise from the textbook, which will give us some further clarification of how these sections or paragraphs in the Income Tax Act work. So let's have a read through this question together. So we have Morton, who is a commission salesperson, gross salary 82,000, commissions 12,200. So the one thing I want to sort of note is that if they claim under 81F, it's going to be limited to commission income of 12,200. During the year, there were a bunch of these expenses. So there was advertising. So let's just sort of list all these expenses. And once again, figure out, can they claim them under F and H and H.1? So remember with advertising, that can only be claimed under F. If we go back to what is under H and H.1, H and H.1, H includes only travel, hotel, airfare, taxis, and H.1 only includes motor vehicle travel. But F would include things such as advertising. So that advertising then can only be claimed under F, and that amount again is 13,100. Oh, sorry, what is it? No, advertising 8,000. Sorry, my mistake, 8,000. Advertising is 8,000. And then there's entertainment expenses for clients. And so client entertainment, basically this is your meals, right? And so when it comes to meals, only 50% is allowed. But once again, for client entertainment, if we go back up to H and H.1, H specifically says that it cannot include meals with clients. So under H, it will only be your own meals if you're away for at least 12 hours from your local area. But under F, if we scroll over, it does include meals with clients. So we can take 50% of those meals with clients under F. So with the meals for clients, 50% of that, 0.5 times 12,000. Oops. So that would be a total of, oh, sorry. Meals with clients is entertainment expenses are 12,000. Yeah, so that would be 6,000. And once again, you cannot include these under H and H.1, so I'll just put a 0 here. And then we have travel expenses. 3,000 was for his meals and 10,100 was for other. So with this travel, this is sort of what we can include under H. So we have travel, we have the meals, which is 3,000. But with the meals, we have to multiply by 50%. So that would be 1,500. That also is allowed under F as well, because remember, everything under H and H.1 is also allowed under F. And then the other travel, the 10,100 under H and H.1, also available under F. And that's the total expenses. So what we can do now is just do a quick total of each column. So we do a quick total of each column. We'll just sort of see where we're at before we sort of determine which is the better claim. So obviously there's more expenses under 8.1F, 25,600, which is under H and H.1, 11,600. And so with this example, which do you think is the better claim? Any thoughts? And the one thing we need to sort of consider is what is his employment income? So under 8.1F, the claim would be limited to 12,200. But once again, that is still more than the 11,600 under H and H.1. So for this one here, the optimal claim is to deduct 12,200 under 8.1F. Any questions about this exercise? Now, the other complication deals with workspace and home expenses. So if you have, let's say, a home office, and once again, if you're required to have home office to do work, once again, that form T2200 needs to be completed by your employer. And this sort of happened during the years where we were under lockdown because of COVID and nobody was allowed to go to work. Employees were allowed to work from home, or they had to work from home. And so the employers had to complete this form T2200 to allow employees to deduct home office expenses. And usually what you do is you prorate it based on the percentage of the square feet of the home office versus the total square feet of your house. And it sort of talks about it in more detail in these pages here. But basically, with home office, once again, it's covered under F and also I. So let's sort of have a look at I. Remember we said under I, right down here, I includes union and professional dues and also home office expenses. Under F, we go over here. F also includes workspace and home expenses. But F includes a few more things that I does not. So I kind of listed them down here. Oh, where am I here? Under both F and I, we're looking at just home office expenses. Those would include operating and maintenance expenses. So for example, a portion of your utilities. You take your BC Hydro bill, you prorate the square footage of your home office over your total home square foot of your home. You can deduct some utilities, some maintenance. So some sort of maybe basic repairs need to be done. The roof is leaking. There's some maintenance expenses. Those can be deducted under both F and also I. But once again, F is limited to your commission income. If you claim under H and H.1, you cannot claim under F. Under F only, it would also include some of your property tax if you own your home, and some of your home insurance if you bought home insurance. Those amounts are not included under I. If you're renting, you can include, once again, a prorated amount of your rent under either I or F. So once again, this sort of just shows how complex the Income Tax Act can be. But let's just sort of break this down into a very simple example. So let's say we have this commission salesperson, and these are their expenses for employment. So travel expenses, they can claim that under F, 1,000, or they can claim it under H and H.1. Motor vehicle travel, same thing. Client meals. Client meals can only be claimed under F, so 3,000 here and 0 here. So just sort of using this example to just sort of illustrate how things can get a little bit complicated. So let's just do a quick subtotal of what we have so far. So looking at just F versus H and H.1, we have 6,000 under F, 3,000 under H and H.1. And then there's also home office expenses. Operating and maintenance, let's say these are the prorated amounts. So the operating and maintenance, that can be claimed under F or H or under I. So this is I here. This is I now. Property tax, the prorated amount, can only be claimed under F, cannot be claimed under I. And home insurance, the prorated amount, can be claimed under F, cannot be claimed under I. So we just sort of do some more subtotals. Let's do a quick subtotal for I here. That's just going to be obviously 500. And then under F, that would be 800. But remember, if they claim under F, they cannot claim under H and H.1. And so we've done these totals. Let's sort of explore 3 different scenarios. So let's say with the first scenario, this employee has commissions of 2,000. Under the first scenario, if the employee has commissions of 2,000, they're obviously better to claim under H and H.1 because if they claim under F, it's limited to 2,000. And then they can claim 500 for home office under I, because once again, they can't claim under F because it would only be limited to 2,000. So for this first scenario, they would claim 3,000 under H and H.1 and claim 500 under I. Any questions about that first scenario?
So they can't claim under 8F and 8I at the same time, right?
Sorry, what was the question again?
So my question was, so the person can't claim the 8F and 8I at the same time.
So we'll get to an example where they're going to claim F and I. So we'll come to that in about a minute or so. But in this first example, where the commission is only 2,000, it's best to claim the 3,000 under H and H.1 and the 500 under I.
Okay.
Yeah, and that's a good question. So let's wait until I get to the last example, and then if it doesn't clear up your question, then I can go and answer that further. Let's look at this second example. Let's say now this employee has commissions of 5,000. So in this example, they are better off claiming under F, not H and H.1, because under H and H.1, they can only claim 3,000. And this is sort of where they can separate this amount. This 500 here, they can separate it. So let's just go look at this. Under this example where they have commissions of 5,000, they're going to claim 5,000 under 8.1F. Even though they have more, they can only claim 5,000, but that's better than claiming under H and H.1. This 500 here, they can say, okay, we're not going to claim it under F. We're going to claim it under I instead. And so they can claim 500 under I now. So the total claim will be 5,500. So with the home office expense, the operating and maintenance, the one that is common to F and I, they can decide where they want to claim it. So if they say, we're not going to claim it under F, we're going to claim it under I, that is okay. Does that help answer your question? I I think that's what you were asking. If you're able to
Yeah.
just, yeah, perfect. Okay. Any questions about the first two examples? Well, let's just sort of do one more. So let's look at this last example here. Let's say now that the commissions is 10,000. Just sort of take a second, see if you can think what would be the optimal claim. So just sort of take maybe 15, 20 seconds, think what would be the optimal claim. You have to choose between F versus H and H.1. If you want to claim under I, you have to make sure that the amount you claim under I is not included in F.
I think the F would be the optimal one.
Yeah, how much would we be able to claim under F?
6,800.
Yeah, you're right. So this one here, because commissions are 10,000, we could claim all 6,800 under F. Or if you wanted to, and once again, this is sort of to show the separation, you could claim 6,300 under F and claim 500 under I. So once again, there's this one here because you're sort of over the total for F. It would just sort of make sense to claim the full 6,800 here. But you could say, though, we'll claim none of that there, and we'll claim the 500 under I. So there is that option as well. But the total claim would be 6,800. I'm just going to do one more. I did not put this on the handout, but this is just sort of one more that will just sort of help us to make sure that we understand how this works. Let's say in this last example, the commissions were 6,250. What would be the optimal claim now? So first question, is it better under F or H and H.1? Obviously better under F because it's more than 3,000 under H and H.1. But under F, we have a total of 6,800, but our commission is only 6,250. So this is one where it would make sense to separate the 500 and claim that under I. So then under F, we would just have 6,300, right? The 6,000, the 200, and the 100, because we moved that 500 to claim under I. But then we can't claim the full 6,300 because our commission is only 6,250. So we could claim 6,250 under F and then claim 500 under I. So it is fairly easy to sort of come to that conclusion, but it requires sort of an understanding of how these rules work. And they do explain it in the textbook, but obviously when you're reading the textbook, it's a little bit sort of hard to sort of visualize what they're talking about. So hopefully these examples here will sort of give you a better idea of how these 5 paragraphs, 8.1f, H, H.1, I, and J, sort of all interact. J is sort of its own little entity. J again is if you, let's say, borrow money to buy a car to use for employment purposes, you can deduct some of the interest, you can deduct some of the depreciation known as CCA, but that's sort of on its own. But the most confusing part comes between F versus H and H.1, and also how the home office interacts between F and also I. Any questions about this handout? So what we're going to do then is that is going to wrap up chapter 3. So make sure that you do complete the chapter 3 homework on eLearn before the due date. And what we're going to do next is we're going to move into chapter 4. So let me bring up the Chapter 4 handout and also make sure that you have your rates table as well. So just a quick refresher, just going to bring up the rates table quickly. Where is my rates table? Oh, right here. So when I refer to the rates table, this is the PDF document that I posted on eLearn that I'm referring to. So remember at the beginning of the term on class 1, we talked about using these federal tax rates to calculate the federal income tax. Chapter 4 focuses on all these federal tax credits. So you'll see that under this heading federal tax credits, we have the basic personal amount, BPA. Then we have spouse common law, supported eligible dependent, caregiver for children under 18, and so on. So whenever I talk about the rates table, this is what I'm referring to. This is page 1, this is page 2, page 3, page 4, and so on. So have this handy as well. This is also available in the front of your textbook. If you have the physical textbook, you can find it there as well, but it is posted on eLearn. So I'm just going to bring up the Chapter 4 handout, and then we will get started in Chapter 4. Now, Chapter 4 starts off by talking about how do we calculate taxable income. And if you remember from the very first chapter that we talked about, Chapter 1 and 2, we said that the first thing you need to do is calculate your net income for tax purposes. And remember, net income for tax purposes, that's the formula that you have on the top here, 3A plus 3B minus 3C minus 3D. What I want to do is just sort of do a simple example to sort of introduce us to what we refer to as tax credits. So let's say that we have this individual, and let's say at the beginning of the year, they have a non-capital loss of 30,000. And remember, non-capital losses we can use to reduce any type of income. We can carry it back 3 years, carry forward 20. Now, let's say in this scenario, the net income for tax purposes has already been calculated. And so net income for tax purposes has already been calculated, and the amount is, let's say, 55,000. Now, to get from net income to taxable income, there's all these deductions that are available. Now, they're talked about on page 195, very, very short descriptions. The one thing we learned last week was this employee stock options. Remember, we said that if you exercise a stock option, you could get a 50% deduction of the amount you have to include in employment income. So that employee stock option deduction comes when you calculate taxable income, not when you calculate net income. We also said last week that under 3A, you have to include social assistance and workers' compensation board in your 3A amount, but the government's not going to tax you on it, so you get to deduct it when you calculate taxable income. This capital gains deduction we'll talk about in Chapter 11. This lump sum payment, this residing in the prescribed zone, very minor. Just read the paragraph quickly on page 195. Very sort of minor discussion about that on page 195. But the thing I want to focus on is these losses. This is where you get to deduct any loss carryovers. So if we were this individual, we have a 30,000 non-capital loss. What we could do is we could deduct that non-capital loss of 30,000 and bring our taxable income down to 25,000. This loss, though, is discretionary. And what that means is we don't have to deduct any of it if we don't want to. We can deduct all of it, 0 or some number in between. But once again, we cannot create a negative taxable income. But if we wanted to, we could deduct the full 30,000. And I'll sort of explain why you may not want to deduct the full amount in a second. Once you have your taxable income, then you calculate both your federal and provincial income tax. And once again, we're just going to focus on the federal component. And if you look at your rates table on page 1, if you have taxable income of 25,000, that's going to be at the federal 15% rate. And so the federal income tax that you're going to pay is $3,750. And then we get to chapter 4. Once you figure out your federal, there's also provincial income tax as well, then you get to deduct your non-refundable tax credits. Now, once again, there's both federal and provincial non-refundable tax credits, but we're just going to focus on the federal ones. Generally, the provincial ones will be very similar, and they'll work the same way. And once again, if you're using computer software, all the provincial amounts will basically just self-populate. The way that these non-refundable tax credits work is you have to calculate your base amount. And so let's say, for example, the base is 30,000. Now, for most tax credits, you multiply the base by 15%, and that's going to give you how much your credits are. So 30,000 times 15%, 4,500. Now, the tax credits that we're going to focus on are non-refundable. And what that means is that if you don't have enough tax to use up the tax credits, you will not get a refund. So in this example, if their non-refundable tax credits are 4,500, the amount of tax they're going to owe after the tax credits is 0. These are non-refundable tax credits, so there's no refund. Now, there are some refundable tax credits that are talked about in Chapter 4, but those are very limited. Once again, those are sort of explained towards the last part of Chapter 4 in your textbook. Over just a few pages, the majority of tax credits are non-refundable. And this is sort of where you have some tax planning. So we sort of go back to this here. We have this individual with 55,000 in net income. They can deduct this non-capital loss, but if they deduct the full amount, they're not going to be able to use up all of their tax credits. So it's better to figure out how much taxable income they want to sort of have. They want to figure out what this amount is. I'll highlight that. They want to figure out how much taxable income they need in order to use up all their non-refundable tax credits. Because remember, these non-refundable tax credits, if they don't have enough tax to use them, they will not get a refund. So if we sort of just work backwards, we basically want the federal tax to equal 4,500. That way, it will use up all their non-refundable tax credits. And so we sort of work backwards. We take 4,500 divided by 15%. We need 30,000 in taxable income. And so therefore, the amount of the non-capital loss we're going to use once again, we have 55 in net income. We want to bring it down to 30. So we're only going to use 25,000. And so that way we will still have 5,000 of the non-capital loss carryover to use in another year. And so that's sort of what I mean by these loss carryovers are discretionary. You don't have to deduct any of it. You can deduct the full amount, but usually you want to sort of figure out what your target taxable income will be and then use just enough to bring it down to that taxable income amount. Once again, most tax credits are non-refundable. The way that most of them work is you total up the base amounts, multiply by 15%, and that is the credit you get that will reduce your taxes. Not all of them work that way, but the majority of them do. And that's what we're going to focus on for the rest of today and also next week are these non-refundable tax credits. Any questions before we move down the sheet? Now, the next part, I've listed the most common tax credits. These are on your rates table, and because there are so many, make sure that you read on your own all the other tax credits that are not covered in the Zoom lectures between today and next Wednesday. Now, most of them work by calculating the base and then multiply by 15%. Most are non-refundable, and most do not carry over. Well, that means if you can't use them this year, they will not carry over. Two exceptions are donations for charity and education-related tax credits. So those are the two exceptions that if you can't use them this year or you don't want to use them this year, they will carry over. Let's talk about some of the most common ones. The one that everyone gets, once again, if you're a Canadian resident, you get the BPA amount. So the BPA is known as the basic personal amount. This changes every year, is indexed to inflation. Doesn't matter whether you're single or married or widow. The full amount is $15,705. That's only if your net income is less than or equal to this amount. If your net income is more than this amount, then your basic personal amount is only $14,156. If it's between these two amounts, 173,206 and 246,752, then you get a prorated amount. And we'll go through an example where we have a prorated amount, but we'll just sort of go through a simple example to sort of illustrate how these tax credits work first of all. But everyone gets the basic personal amount. The amount that you get depends on your net income for tax purposes. If you are married, then one of the spouses can claim the spousal amount. So if you are married, then usually the higher income spouse will claim the lower income spouse under the spousal tax credit. So it is not claimed, the spousal is only claimed by one, not both. And usually it's the higher income spouse because the higher income spouse will obviously have higher income. They're going to be in higher tax bracket. They need more tax credits to bring their income down. But there's sort of a limit as well. The spousal amount is based on the BPA amount that the individual is eligible for. And you have to minus that by the spouse's net income. So let's say that this individual gets to claim the BPA for $15,705. And let's say they are the higher income spouse, they can claim the spousal amount by taking 15,705 minus the spouse's net income. And so what this means is that if the spouse's net income is over 15,705, they are eligible to claim it, but the spousal amount will be zero. So it is limited to the lower income spouse's net income. And this is basically saying that if you have a couple, and let's say one stays at home to maybe take care of the house or maybe take care of the kids, they probably will have very little income. And so this allows the higher income spouse to claim the lower income spouse using the spousal tax credits. But if both parties are working and they both make over the BPA amount, 15,705, then even though they're eligible to claim the spousal amount, it will be ground down to zero. So basically targeting those couples where maybe one doesn't work very much, stays at home, takes care of the kids, then the higher income spouse can claim the spousal. We're also going to see that most of these tax credits, we can add this additional amount if the person that is being claimed for has an infirmity. So let's say you're claiming your spouse is the lower income, and let's say your spouse has an infirmity. When we talk about infirmity, we mean a mental or physical infirmity. Maybe they have a slight mental disorder or maybe some sort of physical ailment. And we'll talk a little bit about what guidelines we have for that in a few minutes. But if the spouse has an infirmity, then we can add 2616 to the BPA amount, which will increase the tax credit. So I'm just going to discuss these and then we'll sort of go through an example to put this all in context. Then we move on to this eligible dependent. This is only available if you are single or let's say maybe divorced. This is not available if you are married or in a common law relationship. So this is basically saying that, okay, let's say that you're single. You can't claim the spousal, so we'll give you this eligible dependent, meaning that you're taking care of somebody. And basically it works the same way, is based on your BPA amount minus the eligible dependent's net income. If that dependent has an infirmity, then we can also add 2616. Now, in terms of who you can claim as an eligible dependent, I'll just sort of give you some notes here. So when it talks about eligible dependent, once again, you cannot be married or you can't be in a common law relationship. So this is basically, once again, maybe targeting individuals that are single or maybe divorced. You could claim your parent or you could claim a grandparent. You only get one claim. So you can, if you're sort of taking care of any of these individuals, they're living with you, then you can claim one of them. And when it comes to your parent or grandparent, it doesn't matter whether they're infirm or not. So it doesn't matter if infirm or not. So it means that they could be perfectly healthy. They don't need to have an infirmity. You could also claim a child, grandchild, or a sibling. So sister or brother. But in this situation, if it's a child, grandchild, or sibling, if they are 18 or older, they must be infirm. If they are under 18, doesn't matter, they can be infirm or not. And so once again, it's a lot of information to take, and that's sort of why I'm typing this all down for you. So that way you can sort of go back and sort of review this to sort of see how detailed these rules are. So the eligible dependent is only available if you're not married, not in a common law relationship, meaning that you don't qualify for the spousal. So if you don't qualify for the spousal, then you can see, can you qualify for eligible dependent? Once again, you only can claim one for the eligible dependent. If you're taking care of a parent or grandparent, you can claim that individual. Doesn't matter whether they're infirm or not, but you take your BP amount minus their net income, and that's your tax credit. If you're claiming a child, grandchild, or sibling, if they're 18 or older, they must have an infirmity, meaning that they have some sort of physical or mental challenge, and so they need someone to help them with certain day-to-day activities. But if, let's say, it's a child or grandchild that's under 18, doesn't matter whether they're infirm or not. But if the individual is infirm, we just get to add this additional amount because obviously they may need a little bit more help, and so there might be more cost involved. Then we move on to the caregiver for child under 18. If you have children under 18, and this is at the end of the year, and if the child has a mental or physical infirmity, then you get to claim 2616 per child. This is only for children that are under 18 that have a mental or physical infirmity. If the children are perfectly healthy, you cannot claim this tax credit. And then remember last week, we talked about all those deductions you get from your paycheck, EI and CPP. If you get EI and CPP taken off your paycheck, you get to claim that amount as a tax credit. It's the lesser of the actual amount and 1,049 for EI. Every year there's a maximum that your employer can take off for EI, and for 2024 it's 1,049. So if you work maybe less, the EI taken off might be a lower amount, and so whatever the lesser of the two is, that would be your tax credit. For CPP, it's the lesser of how much was taken off for CPP and 3,218. Now we're going to talk about CPP in a little bit of detail, but I also want to talk about this last one before we talk about CPP in detail. There's also this Canada employment amount. And this Canada employment amount is only available if you have employment income. It's the lesser of your employment income for the year and 1,433. What this tax credit is basically allowing employees that have employment income. And remember we said when we went through the Chapter 3 handout, most employees do not have a lot of expenses that they're allowed to deduct, but they still have to pay for transit to get to work. They still have to buy certain clothes to go to work, but they can't deduct any of those amounts. So the government introduced this Canada Employment Tax Credit, basically just saying, you know, if you have employment income, we realize that you will have certain expenses that you incur, but because you're not allowed to make many deductions, we'll give you this tax credit, which will be the lesser of your employment income and 1433. But once again, these are the base amounts. So it seems like a lot, but remember, we have to multiply these base amounts by 15%. The one thing I want to talk about in a little bit more detail is CPP. And the reason it's a little bit complicated is that a couple of years ago, the CPP system changed in Canada. CPP basically is the government pension plan. And they're basically saying that when you're working in Canada, you're going to be forced to contribute to CPP, the Canada Pension Plan. When you retire, you can start drawing from the CPP as early as age 60. A lot of employees will wait till 65. You can delay it till 70. But the more you put in, the larger your payments will be when you start taking CPP payments when you retire. A few years ago, they realized that the amount that was being contributed to CPP was not going to be enough to sustain all the future payments that were going to have to be made out. So they basically changed the way CPP worked. And I just want to show you how it's done here. The way that EI and CPP works is that the employer contributes some and the employee contributes some as well. For EI, it's pretty straightforward. The maximum that you get taken off your paycheck for EI is $1,049. The maximum that the employer has to contribute to EI is $1,469. So if the employer hires employees, the employees will get CPP EI taken off their paycheck. The employer also has to put some amount into EI as well. Same thing for CPP. With CPP, there's sort of two ceilings. If your pensionable earnings is 68,500, and pensionable earnings is generally your employment income without deducting any expenses. So usually it's just going to be your gross employment income. So if your pensionable earnings are 68,500, then you get this amount taken off as CPP off your paycheck, 3,218. When your pensionable earnings exceed 68,500, then depending on how much it's over, the additional deduction will be 838. And when you add those two together, I could add them quickly together, 3,218 plus 838. The total is 4,056. That's the maximum deduction for CPP, 4,056. So if you are in that higher employment income range where you're above, what was it, 68,500, you're going to get 3,218 off CPP for the 68,500. And then if your income is over that, then it could be an additional 838. And once again, we're not going to get into the actual calculations, but the 838 would be achieved when your pensionable earnings get to a maximum of 73,200. So it's not really a lot more than the 68,500. It's only a bit more. But when you get to 73,200, you'll get the maximum taken off, which is 4,056. Any questions about that discussion so far? If you get the maximum taken off, 4,056, only 3,218 is a tax credit. The difference, the 838, is a deduction when calculating net income for tax. If you remember last week, remember under 3C, we had moving expenses, spousal support paid, RRSP deductions, childcare cost. I also included the CPP deduction, 838. And I said, we're going to talk about that next week. Well, here we are next week. If you get the maximum CPP taken off, 4,056, only the first 3,218 is a tax credit. Anything over that is a 3C deduction when calculating net income. So we'll sort of keep that in mind. We've sort of discussed a lot about these tax credits. So what I want to do is just do a simple case to put this all in perspective. So we're going to look at assignment problem 4.1, and we're just going to look at this first case here. So we have this individual, Cami, and the net income for Cami has already been calculated. So they've already calculated net income for tax purposes, 96,500, all of its employment income. The employer withheld maximum EI and CPP. Now, even though the maximum CPP was withheld, we know that they would have deducted that difference of 838 when calculating net income. But because they've given us net income, we don't have to do that calculation. So we know that the net income is correctly calculated at 96.5. Cami is married. Bob has net income of 8,650. They have 4 children, and they are all in good health. And so what I want to do is just sort of show you how these tax credits work. We're going to assume that Cami's net income also equals her taxable income. And if you, once again, look at the first page of your rates table. So if you look at your first page of your rates table, remember we talked about how we can calculate the federal income tax. So if you look at your rates table, 96,500, you'll realize that you're above the 55,867, but you're below the 111,733. So you're in that 55,867 row. What you do then is you take the middle number, you take the 8,380, and then for the income that is over the 55,867, so we take the 96,500 minus the 55,867. That difference then will be multiplied by that percentage, 20.5%. And so that would be her federal income tax before calculating tax credits. So we do this calculation. This is going to give us her federal income tax. And once again, there's provincial tax as well. But once again, we're just going to focus on the federal tax in this course. So the total tax then is going to be 16,710, just to round it to the nearest dollar. So that's the total federal tax before tax credits. Now, when it comes to those non-refundable tax credits, everyone gets the basic personal amount, or the BPA. Now, once again, we're going to add up the base amount, and then we'll multiply that by 15%. Now, remember with the BPA, we said that as long as your income was below that threshold, you're going to get the full 15,705. So she's going to get the full 15,705. She is the higher income spouse, so she can claim her spouse for the spousal tax credit. And remember, the spousal tax credit is based on her BPA. So her BPA is 15,705, and it has to be reduced by the spouse's income, which is 8,650. And so the spousal tax credit will be 7,055. All the children are in good health. So remember, scroll back up here. The caregiver for children under 18 is only claimed if the child has a mental or physical infirmity. They are all in good health. Now, the eligible dependent cannot be claimed because she is married. So the eligible dependent can only be claimed if you are single, let's say divorced, then you can claim the eligible dependent. You can claim it once, but because she claimed the spousal, cannot claim the eligible dependent. The other amounts that she can claim would be employment insurance, the CPP tax credit, and the candidate employment. Now, the question says the maximum was withheld. So for EI, we can claim the maximum, 1049. For CPP, we can claim the maximum, 3218. Now, we know that the maximum that was taken off her paycheck was 4056, but the difference of 838 was already deducted when calculating her net income. And the net income number was given to us. So we just assumed that that 838 was already deducted. So for the tax credit, we can only claim the 3218. She also has employment income. So we can also claim the 1433. The question says that all of her income, if we go back to the question, all of her income was employment income. So let's add those EI, CPP, and the Canada employment amount, CPP. And so the maximum EI for 2024 was 1049, 1049. The CPP was 3218, and the Canada employment 1433. And once again, the way that these tax credits work is we have to add up the base amounts. Now, again, it seems like a lot because the base amount is a pretty big number, but then we have to multiply it by 15%. And so that's going to give us a tax credit of 4,269. So once again, most tax credits, you add up the base amounts, multiply by 15%, and that's the amount that it reduces your overall tax by. So the federal tax payable after tax credits will be 12,441. So that's just sort of a simple example of some of the more basic tax credits. Any questions about this first example? Now, once again, when it comes to using tax software, what we'll usually do with tax software is usually sort of ask the taxpayer's profile. Is the taxpayer married, single? If they're married, you put your spouse's social insurance number there. They usually sort of pair the returns together. And so once the spouses or the couple's returns are entered in and they're paired together, it will usually use tax software to optimize which spouse will make the spousal tax credit claim. Once again, it's going to be generally the higher income spouse. But then once the income exceeds 15,705, the BP amount, even though they qualify for the spousal, it'll bring it down to 0. So I don't see any questions coming up in the chat. So let's continue on and talk about some additional tax credits. We now have this Canada caregiver for infirm dependents. So there's a lot of these tax credits that deal with situations where you're caring for a dependent and they have an infirmity. And an infirmity could mean a mental or physical infirmity. And basically it says that if you're caring for this individual, then you're probably going to be spending money taking care of them. So we're going to give you this tax credit. Now, let's just sort of talk a little bit about what we've covered so far. Everyone gets the basic personal amount. That's the BPA. If you are married or in a common law relationship, then you qualify for the spousal, usually claimed by the higher income spouse. Cannot be claimed by both, claimed by one of the spouses, usually the higher income. If the spouse that you're claiming for has an infirmity, you can add 2616 to the tax credit amount. If you are not married and you're not in a common law relationship, then you can claim the eligible dependent. But once again, you have to be supporting one of these individuals listed here. Parent or grandparent, does not matter whether they're infirm or not. If they are, we just add 2616 to the amount. But you can only claim one. You can't claim, let's say you're supporting both of your parents and they both have an infirmity. You can only claim one under the eligible dependent. Well, what about the other parent that you're taking care of that also has an infirmity? And this is sort of where the Canada caregiver for infirm dependents come in. Let's say you're taking care of both your parents, you're single, you can claim one of the parents under the eligible dependent. If both of the parents have an infirmity, then you could claim one of them under this Canada caregiver for infirm dependents. Now, this tax credit, they must have an infirmity. It says so right in the tax credit. It's for infirm dependents, and that person must be 18 or older. So if it's a child under 18, you cannot claim them under this tax credit. This is only for dependents that are 18 or older. Now, who qualifies? So who would qualify under this one? So let's just sort of add some notes here. So this one, they must be infirm and must be 18 or older. Individuals that would qualify would be parents, grandparents, your child, your grandchildren, also siblings. So parent, grandparent, child, grandchild, siblings, those are the same as what we saw here under the eligible dependent. Now, once again, under eligible dependent, there was some rules about whether they had to be infirm or not, or whether, depending on their age. For this Canada caregiver for infirm dependents, they must be infirm and they must be 18 or older. Now, if you claim them already under the eligible dependent, you cannot claim them here. So if already claimed under eligible dependent, cannot claim here again. So let's say you were just supporting one parent and that one parent had an infirmity. It would be better to claim them under the eligible dependent because it's based on a higher amount. This Canada caregiver starts off at only 8,375. So it starts off as a lower amount. So if you're supporting an infirm adult, it's better to claim, well, you have to claim them under the eligible dependent because it's a higher amount. And if you already claimed them under the eligible dependent, you cannot claim them here again. But other than the parent, grandchild, parent, grandparent, child, grandchild, and siblings, it also expands this infirm dependent list. This could also include aunts, uncle, nieces, and nephews. Once again, they have to be 18 or older, and they have to have an infirmity. And there's no limit. If you're supporting a number of these individuals that have an infirmity that are 18 or older, you can claim all of them. But the way that this claim works is you start off with 8,375. And then you minus the dependent's net income, but only the amount that's over 19,666. Now, once again, I'm going to give you an example about how this works. So we'll do the calculation together using an example. But I want to talk about what do we mean by mental physical infirmity? And we are not medical professionals, we are accountants. So in this course, in the textbook, in the examples, they will tell you whether or not the individual has an infirmity. If it doesn't say anything, then obviously they do not. But if they have an infirmity, they'll list it. They'll indicate that in the question. And I want to just sort of talk about what the Income Tax Act says about mental or physical infirmity. The term mental or physical infirmity is not defined in the ITA. So remember at the very beginning of the course, we talked about the definition of persons. We said that the term persons is defined in the Income Tax Act. Individuals, corporations, or trust. If the term is defined in the Income Tax Act, we use that definition. If it is not defined, then we just use the ordinary meaning. So because mental and physical infirmity is not defined in the Income Tax Act, we use the ordinary meaning. And the standard dictionary meaning is that that individual has a physical or mental weakness or ailment. The CRA says it cannot be temporary. So it must last for a considerable period of time. Any temporary illness would not qualify. So you sprain your ankle, you need some help for 12 weeks, that does not qualify as a mental or physical infirmity. It has to be something sort of ongoing. So maybe the grandparent is using a walker for assistance. That would be a physical infirmity. Maybe the child has some sort of mental disorder. And again, we're not medical professionals. The question will tell us if they have an infirmity. What we're also going to see is that there's also this disability tax credit. In order for an individual to qualify for the disability tax credit, they have to have a disability. A disability is greater than an infirmity. So let's say an infirmity is you're using a walker. You can still get around and do many things on your own, but you have some physical challenges, but it's not anything that it means that you need sort of round the clock care. Disability, you're in a wheelchair. You cannot lift yourself out of the wheelchair. You need constant care. Um, if you qualify for disability, you would also qualify for infirmity, because if you have a disability, you also meet the lower definition of infirmity. We'll talk about the disability tax credit probably next class, but that's another tax credit. All we're talking about now is this term infirmity and how it relates to these tax credits that we talked about earlier. If your spouse has an infirmity, then you get to add this additional amount. If you're claiming an individual under the eligible dependent and they have an infirmity, we add this amount. If your child is under 18 and has an infirmity, you get to claim 2616 for that child. If you have relatives that you're taking care of and you have not claimed them under the eligible dependent, then you could claim them under the Canada Caregiver for Infirm Dependents as long as they are 18 or older and as long as they're one of these individuals here. So with that understanding of the Canada Caregiver Tax Credit, let's have a look at this question. And then once we're done this question, we will take a break. So we have Ethan, who is 45 years old, and we're just going to work on case A. Ethan's income, net income has been calculated, 90,000. All of its employment income, except for the deduction of the CPP deduction of 838. Remember we said that if you get maximum CPP taken off, when you're calculating your net income, you would deduct that extra 838. So that has already been deducted. And so in this example, they've calculated the net income of 90,000. So we don't have to do that. His employer also withheld maximum EI and CPP. Now in case A, the one that we're going to do, this taxpayer is married, has a wife, Mia, and Mia's net income is 8,800. Mia's mother, Bernice, lives with them. Bernice has a mental infirmity. So once again, we're told that in the question. The infirmity, though, does not qualify for the disability tax credit. So infirmity is sort of the lower, disability is greater. But she is dependent on Ethan and Mia, and her income, the mother, is 22,000. So we're given net income of 90,000. We're going to assume that that also equals his taxable income. Because remember, it's taxable income that we use to calculate the tax liability. So we're going to say net income and taxable income equal, what was it, 90,000? Yeah. And so let's use your rates table. So once again, use your rates table to calculate the federal income tax before tax credits. And once again, if we look at the rates table, we would again in this example take the 8380, and then the amount over will be at 20.5%. So the amount over the 55,867. So 90,000 minus 55,867. So that's going to be the federal tax before tax credits. So let's just figure that out quickly. So that's going to be 15,377. And then we have all the non-refundable tax credits. And so once again, Ethan will get the BPA. And so the BPA 15,705. He's also the higher income spouse, so he can claim Mia, the lower income spouse. And the tax credit, we take his BPA amount minus her net income, 8,800. And so the spousal is going to be 6,905. Now, all his income is employment, and he got the maximum EI and CPP taken off. And don't forget about the Canada employment amount because he has employment income. So the EI for the maximum is 1,049. CPP, the maximum tax credit is a 3,218. Canada employment 1,433. Those are pretty straightforward, similar to what we did in the last question. The difference with this question is now we have the mother. The mother, Bernice, has an infirmity, and she needs the daughter and the son-in-law to take care of her, and her income is 22,000. So once again, it's not going to make sense for Mia to claim Bernice as a dependent because her income is only 8,800. Mia's not going to have any tax to pay because her basic personal amount, 15,705 times 15%, will eliminate any taxes she's going to owe on 8,800 of income. So Ethan will be the one that will claim Bernice using the Canada caregiver. So it could be a parent and also be an in-law. So if you're married, then your spouse's parents are considered your parents as well for these tax credits. So then let's look at how the Canada caregiver works. So we know that we can claim the Canada caregiver for infirm dependents over 17. And remember, we can't claim the eligible dependent because the eligible dependent is only available to single or maybe divorced individuals. So it's only the Canada caregiver that we can use. We're going to take 8,375 minus the dependent's net income over 19,666. And so the way that this works then, I'll put the calculation down here, is we start off with 8,375, and then her income is 22,000, and then the amount is over 19,666. So if you work through that calculation, we should get 6,000 and something, right? Let's take this. Yeah, 6,041. So once the income of the dependent is over 19,666, it will start reducing. And so once again, if you get a lot of income, then it could eliminate this tax credit. If Bernice had, let's say, income of, let's say, 30,000, it would basically eliminate this credit. Any questions about how we calculated that number? And so once again, we're just going to add up the base amounts. So we're going to add up the base amounts of all these tax credits. We get 34,351. Once again, seems like a lot, but once again, we have to multiply this by 15%. So 34,351 times 15%. And so that's going to result in a tax credit of 3,000. Sorry, is that right? Hold on. No. 34,351 times 15%. 5,000. 153. So just round it to the nearest dollar. And so Ethan's federal tax after tax credits will be 10,224. And once again, there's provincial tax as well. And there's also provincial tax credits. But once again, we're just focusing on the federal amount. I'm just going to make a note here. There is also provincial income tax and provincial tax credits as well. But once again, on computer software, all those provincial amounts would just sort of self populate once you enter your province of residence at the end of the year. It'll use the correct provincial amounts and just sort of base it on your federal claims. Any questions about this assignment problem? What is it, 7:21? Why don't we take a break until 7:30? I'm going to pause the recording. So we spent the first half of today's lecture talking about tax credits. And the ones that we talked about are all summarized on this rates table. So the basic personal amount, the spousal, the eligible dependent, Canada caregiver for child under 18, Canada caregiver for infant dependents, and so on. So the rates table kind of summarize the most common types of tax credits. The Canada employment amount, sort of right in the middle of this page here, right here, Canada employment amount right here. Some of the other ones we talked about, if we scroll down, the CPP-EI right at the top here, CPP-EI is right at the top here. The one we're going to look at next, actually the two that we're going to look next, one is the charitable donation. So this one right here starts at the bottom of page 2, goes to the top of page 3. And then we're also going to look at political donations. So if I scroll down, bottom of this page here, we have the political donation tax credit. So the rates table sort of gives you a nice summary of how the calculations work. It's also talked about in the textbook as well, but the rates table sort of summarizes the main tax credits and how you do the calculation. So let me just bring up the Excel document and we'll pick up from where we left off. So if you look at the Excel document, the next two tax credits we're going to look at is the charitable donations and the political donations. Now, these ones work a little bit different. These ones you do not include in the base. And the reason you do not include it in the base is that there's a different calculation for these amounts. For charitable donations, it's this formula here. 15% of A, 33% of B, 29% of C. A is the first 200 of your donations. B will only be applicable if your taxable income is over this amount. Otherwise, the remaining amount, the amount that you donate less the first 200, will be at 29%. I'm going to show you an example where all A, B, and C come into play, but we'll do that after we do this example. So with charitable donations, not all of the base amount is at 15%. Some will be at 15%, the first 200. Most of the remainder will be at 29%. And B will only apply when your taxable income is greater than this amount here at 33%. Now, you're probably thinking, well, why do we have this B amount at 33% when taxable income is over 246,752? If you look at your rates table, 246,752 is your highest tax bracket. When your income is over 246,752, the income over that amount will be taxed at 33%. So what the government is saying is if you make a bunch of charitable donations and you happen to be taxed at that highest tax bracket, then some of your donations will also get a credit of 33%. With political donations, the first 400 will be at 3/4, 75%. The next 350 will be at 50%. The next 525 will be at 1/3. With political donations, though, there's a limit. Your donations, once your donations reach 1,275, you've hit your maximum credit. You cannot be eligible for any more, even if you donate more than 1,275 in political donations. Now, there are some restrictions with respect to political donations. If you read through the textbook, it'll say things such as corporations are not allowed to make political donations here in Canada. With individuals, there's a limit as to how much you could donate every year. But for tax purposes, once your donations to political parties hits 1,275, even if you donated more, your maximum tax credit will be $650, and that's based on this formula here. And we're going to go through this formula together. Now, with charitable donations, it's limited to 75% of your net income. So if let's say your net income is $100,000 and you donated a lot to charities, the most that you could claim would be $75,000. Now, donations for charities are discretionary, meaning that you don't have to claim them this year if you don't want to. You can carry forward them for up to 5 years. So what that means is if you only donated, let's say, $100 this year, then your tax credit would only be at 15%. But let's say that, next year you're going to donate maybe maybe 300 or maybe 200. Then you might save the 100 that you donated this year to next year, and that's going to bump you up to 300. So then the first 200 will be at 15%, but the remainder will be either at 29 or 33. So sometimes it might be worthwhile to sort of save your donations, your charitable donations, till a later year, till you get sort of more, so that your tax credit will be at a higher amount, maybe 29% for some of the amounts over 200, rather than it all being at just 15%. And I'll sort of explain how these calculations work, and we're going to use this case D here. So this is that same individual. So remember before the break, we looked at this individual, Ethan, and we did case A. This is the same individual that has net income of 90,000, all of which is employment income. So we've already did the calculation here for his tax on 90,000. So I'm just going to copy that down because that is all the same. That is all the same for this one here. It's the same Ethan who has 90,000 in employment income, and we've calculated the federal tax for case A. That's going to be the same for case D. The specifics are a little bit different though. So for case D, his income is still employment income, but in case D, he's not married, has no dependents. He received an inheritance in December. In Canada, we do not have inheritance tax. If you inherit money from an estate, you, the recipient, do not pay any tax on that inheritance. There is estate tax. The estate of the person that deceased, that estate would have to pay tax. But you, as the recipient that are getting the inheritance, there's no inheritance tax in Canada. There is in the US, but not in Canada. He donates 50,000 to a charity, and he's going to only claim 15,000 this year. So remember, discretionary, right? You make the donation to a charity. You don't have to claim it. You can claim it in any of the next 5 years. He's only going to claim 15,000. He also makes a donation to a political party for 1,000. So we're going to calculate the other tax credits first, because remember, with the charitable donation and the political donation, not all the amounts are at 15%. So we have to do a separate calculation. So with his non-refundable tax credits, he's going to get the BPA. Once again, he is single, so there's not going to be a spousal, but his income is employment. So he will have EI, CPP, and the Canada employment amount. And once again, we're told in the information that he had maximum EI taken off, maximum CPP, the maximum CPP tax credit, 3218, Canada employment 1433. And once again, we're going to add these ones up, because all of these ones we will be multiplying by 15%. So the total of these tax credits will be 3,211. So 21,405 times 15%, 3,211. Now let's look at the charitable donations. The charitable donations, 15% times A, which is the first 200. B is only applicable when taxable income is greater than 246,752. And the reason that is if we look at the formula for B, B is the lesser of the amount of the donations. So he's claiming 15,000, right? And the first 200 was already claimed in A. So the amount over 200, that would be 14,800. And the lesser of 1 and 2. Does he have any taxable income over 246,752? He does not, because his income is only 90,000. So B would be 0. And so B is only applicable when your taxable income is over 246,752. So we look at the charitable donation tax credit then. We know that the first 200 is going to be at 15%, which is going to be 30. And then we add to that the remainder, which is 15,000 minus the first 200, and that's going to be at 29%. And so if you work through that, 14,800 times 29%, that's going to be 14,800 times 29%. That's going to be 4,292. So it's going to be 30, which is the first 200 times 15%, and the remainder times 29%, which is 4,292. And so the total donation tax credit will be 4,322. Any questions about the charitable donation tax credit? Now, for the political donation, he donated $1,000. So he donated $1,000 to a federal political party. And the way we do this calculation is for the first 400, it's going to be at 3/4, 0.75. For the next 350, so does he have the next 350? Yeah, because 350 plus 400 will be 750. So he does have the next 350. It's going to be at 50%. And then for the next 525, well, he doesn't have the next 525. So basically he donated 1,000. The first 400 will be at 0.75. So that's going to leave 600. The next 350 will be at 0.5. So that's going to leave 250. And the remaining 250 will be at 1/3. And so once again, if you work through the math, what you will get will be a total political donation tax credit of 558. So 400 times 0.75, that's going to be 300, right? So it'll be 300. 350 times 0.5, it's going to be 175. So 300 plus 175. And then 250 times 1/3. So the total will be 558. Now, once again, round it to the nearest dollar. So this would be all of his non-refundable tax credits. So the total non-refundable tax credits will be 8,091. And so we just do the federal tax after the tax credits. Going to be 7,286. Any questions about that example? What I want to do then is do a couple other examples to sort of wrap up today. The rest of these examples here, we'll do this next week, but we still have about maybe another 20 or 30 minutes, so hang in there. But the medical expense tax credit, we'll look at that on Wednesday of next week. So maybe have a read through this problem here before next week's class. And then we're also going to go through this comprehensive problem here. This comprehensive problem combines both chapters 3 and 4. And it's going to sort of take in a lot of the information that we already learned, but it's also going to introduce a bit of new information as well. So because this is a fairly long problem, make sure that you read this before class. So before class next week, read this problem, Clarice McBride. Also read this problem for Tanya. And we'll do these two next week. This comprehensive problem 4-5 will be sort of a good question that will tie a lot of what we learned in chapters 3 and 4 into this one problem here. So a good review for the midterm, which is in 2 weeks' time. We'll talk a little bit about the midterm too before we wrap up today. But what I want to do next is explore the BPA and also the charitable donations tax credit. So I'm just going to grab the BPA amount from here. So let me just copy this here. And then I'll do the donations again as well. So I want to sort of explore these in a little bit more detail. Because remember we said with the BPA, it's prorated if your income is between these two amounts. If your income is less than 173,206, you get the full 15,705. If your income is more than 246,752, then your BPA gets reduced to 14,156. But what if it's between these two amounts? So it's going to do a simple example here. So let's say we have this taxpayer and their net income for tax is, and taxable income is 200,000. I'm not going to calculate the federal tax amount, but let's just assume that their net income and taxable income is 200,000. And let's say that their spouse has net income for tax purposes and taxable income of 10,000. So I want to just look at what will be this taxpayer's BPA amount. When their income is in between these two amounts, we prorate it. They're going to get some amount between 15,705 and 14,156. And the way we calculate is we use this formula here. So we take 15,705, we minus, in brackets, 1,549, in brackets, times their net income, 200,000, minus 173,205, divided by 73,547. So that's the formula we use. And so if you think about it, we need to sort of focus on what is going on here. So 200,000 minus 173,205, that's basically going to be 26,795 divided by 73,547. And so what this is saying is that when your net income is over 173,205, this first number is going to be higher. The higher it is, the more that it will reduce the 15,705. And the way that this works is that, let's say your income was 246,752. So it'll be 246,752 minus 173,205. We forgot to put that in brackets. We divide it by 73,547. If you work through that calculation, 246,752 minus 173,205, that's going to give you 73,547 divided by 73,547. So this will equal to 1. So what that's saying is that when your income is 246,752 or over, your tax credit will be reduced to 14156. So that number, as it gets closer to 246,752, is going to reduce this amount here. So if the net income and taxable income was 200,000, what would our calculation be? So we would have 15705 minus 1549 times 26,795 divided by 73547. And so that's going to reduce the tax credit from 15705 down by $564. And so the BPA then would only be 1,000 or 15,141. Apologize, it's a little bit messy, but all we're doing is just following that formula there. And the closer it gets to 246,752, the greater that fraction will be. And so that means the greater the reduction will be to the BPA 15705. Now for this taxpayer then, if their net income and taxable income is 200,000, their BPA will be 15,141. They are the higher income spouse, so they'll claim the spousal tax credit. And the spousal tax credit will be based on their BPA, 15,141, minus the spouse's net income, which we were told it's 10,000. So the spousal tax credit will be 5,141. So I kind of wanted to just show you that example where if the net income is between these two extremes, between 173,206 and 246,752, how do we get that prorated amount? Any questions about that example? So just looking at the chat. So once again, all we're doing is we're using this formula here. So this is the formula here. And all we're saying, this taxpayer has income of 200,000. So their BPA is not going to be 15705 because it's more than, their income is more than this number here. But it's not going to be as low as 14156 because their net income is not more than 246,752. So that means we have to use this formula. And all we're going to do is just plug in the 200,000 here. So we're using the same 15705, that's the maximum, minus this here. And all we're doing is instead of putting the net income for tax purposes, we're just going to replace that with 200,000. So 1549 times this here, which is 200 minus 173,205 divided by 73547. So then all we're doing is just taking 15705 times this fraction, 26795 divided by 73547 times 1549. That's going to give us 564. So it's just 15705 minus 564. Perfect. Any other questions? So the other thing we'll look at is the charitable donations. So yeah, another question, if net income is greater than 246,752, then yes, the BPA stays at 14156. And we're actually going to see that in the next example. So good question, Hayden. We'll see that in the next example. So why don't we just go to this next example then? We're going to sort of explore the charitable donation tax credit in a little bit more detail and also the BPA. So let's look at this example. And so let's say that we just have a single taxpayer. and their net income and taxable income is now, let's say, 250,000. And so all we're going to look at is their non-refundable tax credits. So the BPA, because net income for tax purposes is greater than or equal to 246, what was that number? 246752. The BPA is reduced to 14156. So I think that answers your question, right, Hayden? This taxpayer has income of 250,000. Their income exceeds the 246752. And so the BPA is just reduced to the lowest amount, which is 14156. What about if they made some donations? So let's say that this taxpayer also has charitable donations of, let's say, $7,000 and will claim all of it this year. So we have the BP amount. And once again, let's just say that this was all investment income. So there's no EI, there's no CPP, there's no Canada employment. All they had is investment income. So just going to make a note here, all investment income. So no CPP, EI. So they will get the BPA. They're single, so there's no spousal. They have no dependent, so no eligible dependent. Let's just look at the charitable donation. Their donations total $7,000. And if you look at the formula that we have to use, it's this one here. So A is going to be the first 200 times 15%. So that's going to be $30. B is only applicable when taxable income is greater than the 246,752, which it is. So then what is our B amount? B is going to be then 33% times the lesser of two amounts. The first amount is going to be the total donations minus the first 200. And so that's going to be 6,800. The second amount is going to be the taxable income, 250,000 over 246,752. And so that's going to be 3,248. Because remember, the 246,752 is the threshold for when the taxpayer income will start being taxed at 33%. So that's sort of where that number comes from. So the income over the 246,752 is 3,248, and that's the lesser of the two. So we take 33% of that. And so the B amount will work out to be a tax credit of 1,000 and rounded to the nearest dollar, $72. Any questions about the B amount? And then C is basically whatever is left over. So the total donations was 7,000. The first 200 was A. We had 3,248 for B. And so whatever's left over is going to be given a tax credit rate of 29%. And so 7,000 minus 200 minus 3,248. So that leaves 3,552 at 29%. And so that's going to be 1,030. And so that means the total donation tax credit. So the total here going to be 2,132. Um, and once again, this BP amount, the 14,156, that's going to be multiplied by 15%. So the actual BPA tax credit after the 15% is going to be 2,123. So 2,123 plus 2,132. So the total then will be 4,255. So I kind of just wanted to show you those calculations because that sort of shows you how those amounts will be calculated if your net income is sort of over those thresholds. Any questions about those calculations? So I want to talk a little bit about the sort of what's coming up. But once again, I'm just going to make a note here of where we're leaving off for now. So we will start here next week. We'll start here next week. So once again, in preparation for next week, make sure that you read these two questions. Once again, just so that you have a full understanding of the questions before we jump into them, because next week will be the class before the midterm. So we're going to go through this question, and then we're going to go through this comprehensive question here as well. So make sure that you read these two questions before class next week. I want to talk a little bit about what's on eLearn before we wrap up. So let me just quickly bring up eLearn onto the screen here. So here on eLearn, you'll see that the Chapter 3 homework is going to be due this Sunday. So get that done and submitted on time. Chapter 4 homework will be due the following Sunday. Now, in terms of the midterm, I haven't yet finished writing the midterm, but I did put some notes on the midterm on eLearn this afternoon. It will cover chapters 1, 2, 3, and 4. It's going to be a mix of multiple choice and problems. Now, the problems will have the look and feel of what we've done in these Zoom lectures, including what we're going to be doing next Tuesday or next Wednesday. So in terms of the problems, focus on what we cover in the Zoom lectures. Now, the multiple choice questions, there will be a few that will cover topics from the chapter, including topics that we didn't cover in the Zoom session. So you need to make sure that you do read all the chapters because we don't have time to cover every topic in the Zoom lectures. The midterm will be open book, meaning that you can use your textbook, you can use your resources. So you need to sort of make sure that you do sort of cover the readings on your own. There's not going to be a lot of multiple choice questions, might be maybe 2 or 3 that might be on topics that we didn't cover in class, but that's just to make sure that you've sort of covered the material on your own. And as long as you sort of know where it is, because it is an open book midterm, then you can quickly sort of flip to it if you need to sort of confirm what you think the answer is for those few multiple choice questions. And once I have the midterm written, I will provide complete details here on eLearn as to the exact number of multiple choice and the exact number of problems. Now, because this is an online course, the midterm will be on eLearn, but it will be move forward only, which means that you can only go forward, you cannot go back. There will be enough time. I'll give you a breakdown of how many multiple choice, how many problems. I'll give you sort of a budget in terms of how many minutes to budget per multiple choice, how many minutes to budget for each problem. But because it's online and because it's not invigilated, it will be move forward only. The multiple choice questions will be first. So you'll do the first multiple choice question, move on to the next, move on to the next. Once you're done the multiple choice questions, once again, you cannot go back once you advance. Then you will do problem 1, then problem 2, and so forth. For the problems, you will have to put enough supporting calculations to get the marks. So kind of similar to what we did on these handouts. If I just sort of bring up some of the handouts here. Let's see, not this one here. Let me bring up the handout that we just did. So if you were sort of given a question about calculating tax credits and federal tax, I mean, just sort of showing these calculations like we did here, doesn't have to be like fully typed out. You can use abbreviations, BPA, EI, CPP, but enough supporting calculations to support your work. If you don't show the supporting calculations, then once again, marks may not be awarded. And once again, you can use sort of abbreviations that we've done in class. You don't have to type out basic personal amount. BPA, EI, CPP, those are fine. And once again, everything will just be move forward only. Are there any questions that I can answer about the upcoming midterm? We do have a
Sorry, Ronald.
representative. Yeah, go ahead.
To show our work, are
Mhm.
we going to have to upload an Excel file or something, or are we gonna have to like type it into essentially like a
Yeah,
chat box in the
yeah.
in on eLearn?
So that's a really good question, and I forgot to mention that earlier. So you will have to type it into the solution box in eLearn. But what you can do is, if you want to use sort of Excel or you want to use, sort of a Word document, you can type it and put it on Excel, and then just cut and paste it into the eLearn solution box. And so once again, if you are using Excel, just if I was sort of doing this on Excel, then I would just sort of cut and paste this and plop it into the Excel solution box, and then move on to the next question. And once again, if you use Excel, yes, some of your formulas may be hidden, but if I can sort of see that you have the right sort of answer, then you'll get marks for that. If you don't get the right answer, let's say you don't show your calculations for the charitable donations and you're off by, let's say, $10, then you might get sort of a part mark because, part of your calculation was probably incorrect. So you don't have to go to a lot of detail, but you can use Excel and you can cut and paste your work from Excel into the solution box for in eLearn. But no, there won't be any attachments. And once again, that's just sort of a way to just sort of reduce students from sharing work. And once again, because it's an online course, it's hard to sort of invigilate fully. So that's why the solutions need to be typed into the solution box, or once again, cut and paste from an Excel document into the solution box. Does that answer your question?
Yes, thank you.
Yeah. Any other questions? We do have a guest here this evening that just joined us. Yassine Shivji is the president of the Capilano Accounting Association. And Yassine is going to just be talking a little bit about the upcoming tax clinic. I'm just going to actually stop the video first from recording.